Hey there, everyone. Today on the Final Bar, pretty special day here for Stock Charts TV. We have the Godfather of technical analysis live in our studio, Ralph Acampora, co-founder of the CMT Association. We'll also talk about a nice rally day for U.S. stocks with the S&P, the NASDAQ, up about 1% for the day. Volatility remaining low with the VIX back below 13. What does that mean, this low volatility environment? Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the action in the markets using the best practices of technical analysis. The technical toolkit really designed to empower investors to better understand what other investors are doing, right? Quantifying investors' psychology, looking at fear and greed, desperation, euphoria, optimism, pessimism. All of those emotional states, I think, are manifested into stock prices, and by analyzing prices over time, as my mentors like Ralph and many others have taught me, is a really good way of making sense of market activity. We can talk about what the markets could do or what they should do. Let's talk about what they actually are doing, and that's what price can really tell us. When we're looking at the price of the major asset classes, particularly equities, overall, a lot of things to be encouraged by, right? A day like today, the S&P, the NASDAQ moving up another 1%, kind of a nice improvement through the course of the day. It's not all positive though, right? We've had stocks like Visa, MasterCard, payment processors jumping up, kind of pulling back here. You have gambling stocks that have struggled here recently. We're seeing a bit of an emergence in defensive sectors. The top two sectors on the list today, certainly more on the defensive side, real estate and utilities. Let's go through all those charts and as many as we can get to here as we start our market recap. Before we get to the charts and the latest updates on the major averages, I do want to start with a poll question. So as a reminder, make sure you subscribe to our YouTube channel, follow us on the socials, and we asked you recently, which ETF would you own for the next 3 months? 4 choices: large cap growth, large cap value, small cap growth, small cap value. Now, what's interesting about those 4 ETFs at the moment is one of them has been a clear outlier, right? And 34% of you went with what has been working in a big way. Large cap growth has dominated in 2023. It reminds me a lot of 2021, where we talked a lot about the FANG trade and just the dominance of those mega cap growth stocks. We've certainly seen a persistence of that, but more recently, more of a rotation. We saw industrials do better earlier this year. Now it's been more energy on higher crude oil prices. So the IVE, which is a large cap value ETF, doing pretty well also. When I think about those different ideas, thinking about these different groups and I guess styles and themes as I would describe them, I like to look at a couple different things. The first chart I would highlight for you is looking at something that really plays to cap tier performance. So when I do a monthly chart review, one of the charts that we always go through is this one here, which says, where is it? Global regions, factor returns, cap tiers. If you look here, this is looking, the last 6 weeks or so, and I'm highlighting, not all of these, but I'm highlighting a couple of these. Here's large cap growth in blue. Here's large cap core, the S&P 500 in black. So since the August market peak, down 1.1% for large cap growth, down 1.6% for large cap core. But if you go to the small caps, the mid caps, you've had a much tougher row of things. Now, if you look at any time frame, look at the last couple months, you have a very similar sort of progression from large cap growth to everything else. If you look year to date, it's been all about large cap growth, and then large cap core, and then large cap value, then mid caps and small caps and micro caps. So if you're thinking about some of those small cap ETFs, I would be looking for some sort of broader improvement. That's what you've not really seen yet. Think about the IWM, the Russell 2000 ETF has been languishing, and some of those conversations we've had recently has been on the lack of participation in small caps. And what strikes me is this is not just a recent conversation. I feel like I've had this conversation in different ways with different people for a while now, right? It's been, when the market's gone up, it's been mega cap growth. That tells me 2 things. That is a decent thing to bet on, and the strength in charts like Alphabet certainly still there. But it also tells me that if and when we get a change of character, if small cap value starts really performing well on a relative basis, I think that is a development that most investors are underprepared for and probably underpositioned for. So keeping an eye on some of these charts, particularly some of those ETFs that you thought were an obvious no pick in that poll, I would take a look at all of those. Keep an eye on where you start to see rotations. The RRG, by the way, Julius DeKempener was our guest yesterday. RRG is a really good way to think about those rotations as well. Thanks for answering that poll question. As a reminder, subscribe to our YouTube channel, like the video while you're doing it, and also make sure you follow us on social media. You won't miss the next poll. Let's get to our market recap, some of the other information about movements through different asset classes. The S&P, the NASDAQ composite, both up 0.8% today, so almost 1% higher. That's not a dramatic update, but I think it's important that the S&P now back above 4,500. Not that a level like 4,500 or 4,400 or 4,600 are it. I mean, that's not the only data point to look at, but I often find those big round numbers, a 100-point change, is often a really good time to take a step back and just see if you're getting that follow through that you might expect on something like the S&P or the NASDAQ. For now, the S&P getting back above 4,500 is not a bad thing as long as it holds that level, continues to progress toward 4,600, which would be the high from earlier this year, even beyond to 4,800, its all-time high from previous years. That would be the ideal bull market scenario from here. But to get to a 50% gain, you first have to have a 5% gain. So keep an eye on a level like 4,500 for now in the rear view mirror at today's close. Watch mid caps and small caps as well. The S&P 600 small cap index about doubling the positive day for the S&P, up 1.6%. So thinking of that poll question today, small caps really getting it done on a relative basis. Now, when you think about the sector movements, that's a lot of times what fuels that difference between large and small cap benchmark performance. Large cap benchmarks like the S&P and the NASDAQ, way more growth heavy, way more tilted towards the FANG sectors, technology, communication services, consumer discretionary. Things like financials and energy and industrials and other less weighted names in the S&P are a little more magnified in the small cap ETF. So when other sectors are doing better, small caps have often outperformed, and that's what we saw today. Look at the VIX, which has gone down to a 12 handle, so below 13. I believe this is actually a new low for the year. We'll look at the chart here in a few moments, but down another 0.7 from yesterday, so the VIX down at 1280. What I would say is a classic bear market scenario from this point on would be a breakdown in stocks and a spike in volatility. We have super not seen that. We're seeing the opposite. We're seeing stocks actually hold okay, and we're actually seeing volatility come down. Markets usually don't tank on lower volatility, right? Because the VIX is the fear gauge. It's an uncertainty gauge. So when people get nervous, when people get panicky, when they start making rash movements in their portfolio, volatility tends to spike. That is not the environment we're seeing just yet. So again, I have a bullish cap. If I put that on, I'm recognizing that low volatility usually means low downside risk until that changes. For now, it hasn't. Looking at interest rates, you see 10-year yield, the long bond yields all moving higher slightly today. So the 10-year yield finishing the day just below 4.3%. The long bond yield just below 4.4%. So still fairly elevated to be sure. And again, one of those great head scratchers of 2023, rates going continuously higher, growth stocks still managing to do just fine. I think at some point that relationship starts to right a little bit, meaning either growth stocks start to rotate away from a leadership role, which we may have seen on stocks like Netflix rolling over this week yet again, or rates start to come down and recognize the fact that economic conditions are okay and that rates, maybe the Fed is done with their rate hike cycle. For now, you're getting a weird juxtaposition of higher rates, which usually does not mean good conditions for growth, but growth stocks continuing to work. The dollar index up as well, up about 0.6% today. Looking at commodities, gold prices pretty much flat from yesterday's close. Silver prices down about 1%. Crude oil prices continuing to go higher, and I think that's one of the big sort of recent themes that we've seen emerge. Stronger crude oil prices tend to mean a couple different things. Obvious takeaway would be strong energy stocks, and that's certainly what we've seen. You've seen the XLE break out. You've seen a lot of individual names like Occidental and others starting to show some renewed signs of strength. Stocks like ExxonMobil testing significant resistance levels, but overall trending nicely here in the last couple months. Also tends to weigh on things like airlines and consumers and people that don't enjoy higher fuel costs and don't enjoy it costing more to get from one place to another. So we are seeing all those things kind of play out pretty well. Retailers obviously have been struggling a little bit as well. Cryptocurrencies all in the green today. We talked about with Bitcoin, that 25,000 level. We'll bring up that chart here in a few moments as well. We continue to bounce off support. Bitcoin and Ether prices both up about 1.6, 1.7% today, and all 10 of the most common coins we track on our platform all in the green today. Now, an interesting look when you look at the sector performance, the top two sectors on a day when the S&P is up 1%, the NASDAQ having a decent update, conditions look pretty good. Look at what's at the top of the list. Real estate up 1.9%, utilities up 1.5%, materials up 1.4%. You have to get to number 4 to get to one of the 3 FANG sectors, and something like technology, while having an update, which is good, kind of at the bottom of the list. So you have sort of a weird scenario here over the last couple weeks where things like utilities have often been number 1 or number 2. Energy, on those other days, it's usually been energy. It's been very rare we've seen those growth sectors at the top of the list. Now, the reason why I would not say this is a huge rotation just yet is because if you spread out and you look at the longer term, those growth sectors are still doing very well. And again, yesterday we talked with Julius DeKempener using the RG research. We saw the rotation still reinforcing the long-term, medium-term, long-term strength in growth stocks. We had David Cox of Raymond James on earlier this week, also talking about offense versus defense, continuing to see the offensive sectors in general over the longer time periods outperforming defensive sectors. Watch for days like this to continue for those ratios to start to favor defensives. That would be a warning sign. For now, I think it's just something to observe and to keep track of. Let's look to a daily chart of the S&P 500, see how today's movement fit into the big picture. Yesterday on the show, I think it was yesterday or the day before, we talked about sort of this, what we might label a pennant pattern. I kind of stay away from the labels necessarily and just think about the consolidation, right? There's no denying that after making a new high in July, this initial pullback in August, now we've sort of been chopping around here. And if you think about it, the market's sort of rotating around 4450 to 4500. Today, another nice update, getting back above the 50-day moving average might be an important thing to recognize. And we're testing a trend line. If you take the high from July and you take the high from August, we're kind of right there. Now, this is a short-term kind of what I'd call a tactical trend line, but we break above there. That could indicate a resumption of this uptrend. A lot of time, pretty common in the technical toolkit, and a lot of different tools that I could bring up, like Elliott wave or other sorts of things, have this idea of a move in the direction of the larger trend and then some sort of consolidation. John Bollinger talks about a narrowing of volatility before the big move. Maybe that's what we're setting up for. In any of those cases, you really have to wait to see which way we break after that. And that's what I would be looking for here in mid-September. And again, one of the seasonally weaker parts of the year, particularly in a pre-election year like 2023, but for now, the market doesn't necessarily care what you think it should do. And for now, again, still consolidating, but I would be looking to see if we get that breakout. And I think breaking above that late August high, just below 45.50, that is, could be an important confirmation of maybe this corrective phase. That's it. Maybe that was the pullback and we rotate higher. What's interesting, though, is that is what the S&P looks like. This is what the chart of Netflix looked like. Now, is this a horrible bearish chart? 100% no. Is this a broken chart? I don't think so. Is it less bullish than it was in mid-July as it was making higher highs pretty consistently? I think that's fair. And I think what you have to remember about a chart like Netflix is it really is more range-bound here over the last couple months. Think about the S&P sort of consolidating. You're seeing those similar consolidation patterns, a bit of a pullback here with something like Netflix. It's dropped here in the last couple days, testing a new swing low. Now, Charles Dow taught us a couple of years ago an uptrend is a pattern of higher highs and higher lows, a downtrend, a pattern of lower lows and lower highs. When something like Netflix puts in a clear lower high and then starts making lower lows, it certainly doesn't cause me to be super bullish on the chart at that point. It tells me to start thinking more about risk management, about thinking about downside protection as opposed to upside potential. And I think we could be near that point with Netflix really touching 400, gets below there, gets into the 300s. That takes us below the August low. The 200-day moving average is in play. The momentum overall not particularly strong. In this most recent bounce, the RSI remained just around 60, which is usually more consistent with a bearish phase than a bullish phase. But let's look to see if the breakdown actually occurs. Now, with that is what Netflix looks like. You have Alphabet just looking like everything is just fine. And I always think that's interesting on a chart like Alphabet. If you didn't know that the markets were in this pullback phase, that there's a lot of debate as to whether we see further deterioration or whether we see a resumption of the uptrend, charts like Alphabet are saying everything is just fine, right? Long and strong up and to the right. And I think that's a great argument for the value of using technical analysis in this sort of scenario. This is when being a trend follower can be magnificent. don't worry, I think less about price objectives, right? What happens if Alphabet hits 140? Should I take profits? I was taught follow trends and let the chart tell you when the trend is no longer in play. For now, higher highs, higher lows. This is a strong uptrend, price above 2 upward sloping moving averages. It's outperforming the benchmark. What's not to like about a chart in that particular scenario? Just to keep going back and forth between, I think, stronger charts and maybe more questionable charts. First Solar, which is in the renewable energy equipment space, obviously a solar name, testing support as well. With charts like Netflix, they've pulled back, right? They're no longer making new highs. And if you look at First Solar, it made a new high in March, retested that resistance level. Look how many times we've tested that resistance around 220. 1, 2, 3, 4, 5 times here in the last 6 months. We continue to rotate lower. Now we're testing support. We've broken down through the 200-day. We're now testing price support from May of this year, right around 170. That level holds. This is a nice reconfirmed level of support with upside potential, maybe getting to the upper end of that range as long as we can get above those moving averages. But if we break that level, what does that tell you about the phase that we're in? I think if that happens, you have to think of this more as an accumulation phase or an uptrend phase, more of a consolidation, a sideways market. I think a break below 170 tells you we're now more in the downward phase, and be concerned about stocks that are no longer breaking out and are starting to fail to hold support. Just one other quick chart I wanted to highlight, Visa and MasterCard. We were recording a podcast earlier today for our upcoming podcast at StockCharts.com, and I was talking with Grayson Rose about some of the payment companies, credit card companies. Visa and MasterCard came up. These are some of the stocks we've been talking about recently here in the Stock Charts team, breaking above 245 for Visa. Nice breakout, and the last couple weeks have looked particularly strong. Today, gapping lower. Now, gapping down to an ascending 50-day moving average, not necessarily the end of the world. It fails to hold those key short-term support levels. That's how long-term downtrends can begin. Let's take a quick commercial break. We'll be back with a fantastic guest, Ralph Acampora, co-founder of the CMT Association, live in our studio here in Redmond. We'll be back in a minute.
Investing is hard. We make it easy. StockCharts' technical scan workbench provides members with the tools to instantly find opportunities in the stock market. Run your scans on over 50,000 symbols in our database to help streamline your investing workflow. Using custom scans enables you to find new trades and investments in seconds. Predefined scans let you access our extensive collection of pre-built bullish and bearish technical scans. See what's moving the markets and find essential charts to watch by following our predefined technical alerts. Predefined scans make life easy to filter the market for promising opportunities. Scheduled scans let you set any of your technical scans to run automatically at a specific time. You can choose to save the results in a brand new chart list or into an existing list from your account. When your scheduled scans run, you'll automatically receive an email with a link to the day's results. Stock Charts, built to empower the modern investor.
Hey everyone, welcome back to the Final Bar. I'm your host, Dave Keller, here at StockCharts.com. Thank you so much for joining us every weekday after the close for our show. A couple quick announcements before we bring on today's guest, Ralph Acampora. First off, we welcome your questions. Our mailbag is fueled by people like you trying to use the charts, trying to use the technical analysis toolkit. What are you running into? We're here to help. Email us your questions at thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV, so just tag us in a comment there. On our YouTube channel, of course, just drop a comment below the video that you're watching. We'd love to hear from you. We'll hope to answer your question live on the air in our next mailbag segment. Also, we had a fantastic live Q&A on Wednesday of this week. We'll do another one next Wednesday. Every Wednesday, 1 p.m. Eastern, 10 a.m. Pacific, we'll be in our podcast studio sharing some charts and then opening it up to all of your live Q&A. So make sure you tune in. If you go to our YouTube channel, you can set a notification for next Wednesday's live Q&A at 1 p.m. Eastern. I am super excited to bring on today's guest, Ralph Acampora. Ralph is one of the co-founders of the CMT Association. I'd say he's a mentor, but I feel like most people on Wall Street would probably say that at some point in their career, that Ralph influenced them. But for me and many others in the technical analysis community, Ralph's input and influence was remarkable and continues to be so. Ralph, it's so good to see you. Welcome to the studio.
Oh, thanks. Thanks for having me.
I'm so glad you made the trip. Yeah. And I feel like seeing you reminds me of many CMT Association events, feeling like getting together with old friends. And you were talking to me before we started about just the history and how that really is how the organization started, was just bringing people together, right?
Yes, I'm very proud of that because years ago, technicians were scattered all over the place. Right. You know, you had Richard Russell in La Jolla, California, A.J. Frost up in Canada.
yeah.
Yes, he was Elliott Wave, and that guy with Russell was Dow Theory. And it was the organization that finally pulled them all together, and that's where we met, shared ideas, and it kept growing and growing. And I'm so proud of that. Yeah, and today people like yourself are doing just a marvelous job. Instructing, teaching, applying it, and I thank you for that. That's great.
You're kind of say that we had very good mentors, Ralph, as I hope you know. Let's get to the markets and talk about what we're seeing. We have your chart. We're talking about the low in October and what a transformational sort of movement that was. Talk to us about the daily chart of the Dow and what you learned in October of last year.
Well, if you could zero in on October 13th, 2022. Now, I've been looking at charts for 56 years, okay? That was like someone throwing a bucket of cold water on me that day. Because that Dow, between its absolute low and its absolute high, well over 1,000-point gain. Absolute low, absolute. It was up 8% on the day. And notice that engulfing pattern. Look at the days prior to it. It's just the high is higher and the low is lower than those few days. And that, to me, is very, very bullish. And I have to say, it even ended by making a double bottom in the Dow. So since the October low of last year, I have been very bullish on this market. I still think we're in a bull market. Now, if we look at it weekly, you're going to see phases of a bull market. Coming out of that low in October, everything bounced. So the first leg up, it was just, everything just, but notice, after that correction in late year and then going into earlier this year, the market went sideways and had a correction, But coming out of that correction, the leadership changed. Oh, by the way, I didn't say this. All the way up, the sentiment on the side of the market was very, very bearish.
Pretty bad.
Oh, yeah. I think there was like $57 billion in cash sitting on the sidelines. And coming out of that low in March, and even into that rally when the market started to make new highs, people still were negative. And I was saying to myself, boy, they're not looking at the rotation. Rotation is the lifeline of every bull market. So what we were starting to see in June and July were the technology stocks taking over. And I think you made a comment earlier saying something about people were looking at 2021 and comparing it. Hey, listen, in 2021, when the glamour stocks popped, that was the popping in the bubble. Those companies didn't earn money. They weren't real companies. It was dot this and dot that. They were ridiculous. Today, these companies that are making new highs like Google and things like that, they're actually wonderful, sound, fundamental companies.
Quite a bit of money.
Absolutely, yes. Did in July and late July, did they get a little ahead of themselves? Absolutely. And that decline that we had in August was definitely overdone. We needed to do it. And I like your comments about the last couple of days because starting to look like maybe that correction's over. Again, I have to go back home and check my stats too, because I honestly thought it would go a little lower, the August correction. I thought we'd go down about 5, 6, 7, 8%.
So, and I'm glad you said that, Ralph, because I mean, I think we're probably in the same, but you and I are wired very closely, and it's mainly because I learned from you and others like you about how to go about what we do. But I was surprised that the correction wasn't as significant as it was. Does that concern you about what comes next? That, does that mean that there's a correction that we're just kicking it down the road, or what makes you confident that we recover?
No, it doesn't concern me. It says to me that there's another leg coming up in the latter part of this year, and I think you mentioned S&P at 4,800. Why not? Why not?
When you think about, when I think of you, and you invited us out to your farm in Minnesota, we shot a fantastic documentary around the barn when you were looking down, going around that and talking about the history of the markets with you was a fantastic moment that I will never forget. When you think about it, I think a lot of people are skeptical when markets make new highs that obviously that's it, right? But when I think about your barn, the trend kept going up over time. How is that how do we not lose focus in that long-term trend in the markets? Or why do we struggle with that?
My wife got upset with me because if I had to go up to new highs, I had to put another ladder up, and I kept going higher and higher. She says, "Where are you going?" I said, "Oh, I got to follow the market." So I can understand that. People, listen, we all, you know, you look back and say, gee, a new high, maybe it's a little extended and all.
Yeah.
But again, the work that you wonderful people do is you look at the internals, you know, you look at what sectors are shifting, you know. That tells you whether there's more strength coming. And again, rotation is the lifeline of every bull market. So
You know,
I look forward to it.
I'd mentioned in the market recap, you know, charts like Alphabet, and I remember posting on social media not too long ago, like how bearish do you want to be when Alphabet looks like this, right?
Thank you.
And so when you think, and again, I probably took that quote from something you mentioned in a presentation years ago, but I remember, and I think market history is filled with those leading names that keep working, and it's just a reminder. What would you need to see if conditions are pretty sound, which I certainly agree with, medium term, long term? What would you need to see that would cause you concern? What would tell you things are getting worse? Is it leading stocks like Alphabet really, you know, they pull back much more? Is it breadth conditions deteriorating? Like, what would tell you, okay, this might be a deeper problem?
That's a good question. I think I'd have to see a lot of the recent leadership. I'd have to see a lot more deterioration than I'm saying. I'm seeing pockets of it, and you know, what's really scared me the other day was Google. It was doing so well. All the analysts on television were saying, the earnings are great. And then bang, they hit it so hard. I said, ooh. And that looked good technically, too, when that happened. So I was, if I see a few more like that, I will not have a very good night's sleep, I'll tell you that much.
So one of the scenarios that we've certainly seen play out is inflationary pressures, which have been talked about quite a bit, but higher interest rates. And for me, I started in the industry, you and I were talking earlier, I started in the industry in 2000, right after, you know, right as the tech bubble was popping. And so that's when I was taught technical analysis, when everything started going down. But I've never really invested in a rising rate environment. You know, when you think about higher interest rates, for someone who's never experienced that, what would you tell them about how to survive that sort of experience?
You're talking to an old man, okay? In 1994, I bought my apartment in Lower Manhattan.
It's a gorgeous place.
I paid 10% mortgage, and I kissed the bank. They didn't charge me 12%. And I listened to people crying today, say, well, the mortgage is 6-7%. If you look at, I don't think you have it. If you look at the long-term picture of rates, I'm going back 60 or 70 years. You know what? We had 30 years up, and in the 80s, the period I'm talking about, we had the high interest rates, 21%. Then you had 30 years down, where rates were down to levels of 1-2%. Okay, what we're looking at is a cycle back up at 30 years. I won't be around to see rates back up double digits, but I think this generation's got to get used to rising rates over time. I'm not saying it has to be immediate. In fact, rates, I think, a little ahead of themselves now. Maybe they'll pull back and consolidate.
They've come up so quickly. I know for a lot of them that's been concerning. For anyone who is still trying to send kids to school and need to borrow money at times, it certainly, I mean, it hits home. This is the 30-year bond yield, really, to show what you're saying.
Exactly what I'm talking
Starting in the 1940s, I mean, there's this huge ramp up. This is when Ralph is trying to get your apartment back here, wherever it was, like right about there, and you're thrilled, But then it's continued, but it's been such a long downtrend. So the rally in rates we've seen is just this. I mean, it's that. Compared to this long-term giant, I mean, it still
exactly
could be
what
much
I'm talking
earlier
about.
on.
Now, let's see how straight up it went from the recent low. So that's a little extended. So just from a technician's point of view, that will probably pull back and consolidate a little bit. But long-term, that major downtrend, no 30-year downtrend in rates, that's over. That's finished.
It certainly seems any trend line you would have drawn has probably been broken by now.
Actually, I don't know if you can do this, but I did it a while ago. When rates go above 5%, and sustainably above 5%, sustainably above 5%, I believe that's when the Dow peaked in the early 70s. And for 15 years did nothing until Reagan came out and started cutting rates. So I could live with this. I could live with a little higher. I could see corrections at all. But if it's above 5%, I think that's the red line for me.
Yeah, right.
Yeah, long term.
And there's still some room between where we're at and 5%, to be honest with you, right? There's a little more upside. You know, Ralph, when you're looking back, and again, what I've always appreciated is anytime I've talked to you in the last 23 years, you always have a good sense of where we're at, and then you have a perspective of market history and a great career. When you look back at a 50-plus year incredible career, when we interviewed you, it was right around your 50-year Wall Street celebration. When you look back, what call, or what moment are you most proud of when you think about what you've been able to do? Or what moment, I guess, career-wise, stands out to you?
Well, the thing that I'm very proud of, and
Yeah.
I think we talked about it a moment ago, was Friday, December 17, 2004, when
Right.
myself and 3 other technical analysts went in front of the SEC and FINRA, and we fought for technical analysis. 3 months later, in 2005, the SEC approved technical analysis, and our CMT examination
Yeah.
is now equal to the CFA
Yeah.
respect and professionalism. For that, David, I am so proud of.
It was a pretty big moment in technical analysis history, and you, of course, were instrumental in making that happen.
I just happened to be in the right place at the right time, and I had so much fire in my belly. I said, Sarbanes-Oxley law, no way, it's going to dump us. You know, they were saying that analysts had to take these Series 86 and 87, and unless you do that, you're not considered an analyst.
Yeah.
And you had to be a fundamental analyst, and that
Yeah.
just like, wow. You know,
Yeah.
and here I was an analyst for 30 years, and all of a sudden, you just wasted your time looking at paper.
So you have spent so much of your career, I think. I mean, obviously, you've been instrumental at you know, talking about the markets and thinking about the markets, but you've had always a focus on education. You taught at New York Institute of Finance for decades. Most people that I ever met in New York had either taken your course or certainly knew someone who had taken your course, and you and Alan Shaw and others did so well to do that. When you have new investors just starting now who don't have the benefit of your experience, what would you tell them to keep in mind as they're starting to use technical analysis? What words of wisdom would you impart to a new analyst?
Well, if you're really serious about it,
Yeah.
and you really want to know the subject, you really should go for your CMT designation. And I don't mean that because I want to pound it. It is such a comprehensive set of exams. There were 3 of them, and they cover everything. And as I jokingly said to someone the other day, I helped write the first exam in the 1980s. If I had to take that test today, I don't think I'd pass it. I mean, it's tough, but they really make you study. And I think if you're really serious, go for it.
Yeah.
Yes.
I'm on the exam committee now. We have made it harder,
are?
Ralph. Yeah, full disclosure. We've built on it, but I think it's helpful. And I think what
you're
we've
so mean. What?
I have no doubt you would pass it 100% though. But when you think about it, right, I think what the technical analysis toolkit that I learned, it's always been about how you apply that to your portfolio. And when you think about risk, I think in 2023, a lot of investors that maybe, hopefully, are sitting on some really good gains are worried about this little pullback, which was brief, felt really painful for someone who's not experienced that. What would you tell people to survive, or how do you think about technical analysis, particularly for managing risk in this sort of environment?
Well, when you come to the marketplace, you know, everybody wants a great return. We know that, okay. But you have to protect that. Risk is very, very important. Maintaining some kind of a discipline. That's what technical analysis is all about. You follow trends or whatever indicator you're looking at, moving averages, make sure if those are broken, that's your out point. You know, so limit your risks, and I think long-term you'll do better. And technical analysis is so helpful in that.
Yeah. It's so interesting when you and I were talking about going around your barn. One of the things I remember vividly, it was around the corner of one of them, and we talked about how the market goes up the escalator and down the elevator, right? It kind of goes up the staircase and down the elevator. Can you explain what that means and why we should keep that in mind?
The picture that you're talking about, the corner of it was the corner of the building. In fact, one of my very good friends, Craig Johnson, you know, Craig, he said, Ralph, you cornered the market. And on one side, on the left side, was the 20s. When the market went up from the early 20s, and 1921 was the low to 1929, that was the Dow was up 500%. And even in the middle of that, there was a small recession, a 6-month recession, because Henry Ford was switching from the Model A to from the Model T to the Model A, and it had stopped, and the country just held on, and then it took off because everybody was buying the car. And then, of course, the other side of the bond was the crash. An 89% decline. And right at the bottom is Franklin Delano Roosevelt. He came in, and poor President, we were talking about Herbert Hoover, the president, was saying, oh, it's only a temporary decline, don't worry about it. At the end, they hated the guy, the poor guy. He had nothing to do with it.
Right.
But that's history.
Well, it is
that
history.
That's a beautiful corner.
I was going to say, and what that taught me walking around there with you is just, I mean, technical analysis is such a visual discipline, but that was a brilliant way of just showing the power of visualizing market data.
Thanks for saying that. I call it data visualization.
Yeah,
yes.
Right.
That's what it is.
Ralph, this is awesome. It's so good to see you. Thanks for coming on the show. Thanks for inspiring me and so many others to do good things. And I appreciate it.
Okay, good.
That's Ralph Acampora. Ralph is one of the co-founders of the CMT Association. Again, a great influence to me and so many others. What a brilliant discussion, particularly about the importance of data visualization. Ralph and others were instrumental at promoting technical analysis in the industry. You talked about it at the beginning. It was a group of people just getting started now. You think about the reach of a global organization and also the power of technical analysis to empower individual investors to improve their returns and better manage risk. Great words of wisdom, as always, from Ralph Acampora. We have to wrap the show, folks, and go to the 3 in 3. 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. You know, as I'm talking with Ralph and others about the long-term trends, just a great reminder of the discipline of technical analysis, sticking with trends that are working. Here we're looking at a ratio of the SPY stocks versus the TLT bonds. I ask you, is this chart going up or down? It's been going up, and not just for a little bit, it's been going up consistently. Now, this is through, coming out of the COVID lows. This is coming through a bullish phase like 2021 and 2023, a bearish year like 2022, and overall stocks have continued to outperform bonds. I'm a big fan of following trends until the trends are no longer in place. For now, this ratio still appears to be going higher, which tells me, given the opportunity, you continue to lean into what's working and lean away from what's not. This is saying stocks over bonds, still the story. Chart number 2, I mentioned in our market recap just some of the relative performance of some of these different cap tiers. You can use sharp charts on our platform and other tools to look at different time frames. And I'm just looking since the short-term pullback, right, from the end of July to where we're at here in mid-September, about a 6-week period. I've highlighted 4 different ETFs, and I have 10 altogether that you can see listed out here. Large cap growth has done the best. Now, all of these are down, of course, still sort of attempting to get to regain back to their August peak. But large cap growth, top performer, that's the only one of these cap tiers. If you look at all the mid cap and small cap ETFs, large cap growth is the only one that's outperformed the S&P over this last 6-week period. And the smaller you go, the worse your returns have been. So for now, that trend is still in large cap growth, but I think it's really important to watch some of these other parts of the market, because if you've been ignoring small caps, when they do start to work, you won't be there. So make sure that you keep following the charts and recognize when those trends may be shifting. Finally, let's get a little more granular. Cruise lines have had a tough go of things recently. Norwegian Cruise Lines and others have been pulling back. NCLH actually just tested its 200-day moving average. What I like about this, it's actually what you call a confluence of support. This is a key Fibonacci level. If you take the high from July, the low from March of this year, we've retraced about 61.8%. That lines up almost perfectly with the 200-day moving average. I was taught nothing good happens below the 200-day. For now, stocks like this are holding the 200-day, and as long as that's still the case, I think that's still a decent chart to be looking for. Folks, that's a wrap for this show. Thank you so much for joining us every weekday after the close for the Final Bar. A special thank you to Ralph Acampora, co-founder of the CMT Association, joining us here in our Redmond studio. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.